we have this situation where, with the outflows of capital accelerated by the carry trade, as individual institutions in the US and elsewhere would rush out and borrow yen in order to sell the yen to buy dollars and then invest the dollars in T-bills for a yield pickup, really, of about 5%, leveraged up so that your return on your underlying capital is probably 50% if you leverage it up 10 times. You can see how this thing was taken to excess. And this was why the yen rate against the dollar fell from around about 100 to about 161.5, which was the lowest level for the yen. The numbers are upside down, incidentally. You need to invert the chart. The selling of Japanese institutions' interests came at a very difficult time for the US market, because it was about that time there was some disappointing earnings coming through from, the Magnificent Seven, the top tech companies. And so you had this combination, if you like, which was driving down equities. And it is a crisis. And I think it's very much akin to the crisis that we saw, our grandparents saw in 1929. You have the first leg, where there is the panic. The panic subsides, the authorities come in, and in late 1929, the Fed actually did pretty much what it would do today. It went into the market and bought US treasuries to keep interest rates down. It made reserves available for the commercial banks so that their balance sheets they will do the same. They will have to panic and cut interest rates. My guess is after we've seen something like a 30 to 40% fall in the S&P, they will cut interest rates. I can see the meeting, emergency FOMC meeting today. When that happens, I think markets will steady. This is what happened from around about November 1929 and ran through to around about May to June in 1930. Then the market started its pernicious decline from having rallied about, regained about half the initial fall. You then had this long, pernicious decline down to a low level where the Dow fell, roughly lost 90% or 89% from the top by mid-1932. I won't describe the crises that came with it, like banks failing and all the rest of it. This is the sort of thing which we can envisage being repeated today. But you can see that the structure of the market, of the bear market, is actually quite clear in advance. We can see this in advance. So to summarize, you've got the initial crash, where everybody throws their toys out of the pram. We all get terribly worried. Banks start worrying about the value of the collateral they've got against loans, all that sort of stuff. The Fed comes in, has to rescue the situation. Calm is restored for a number of months, and then the real decline starts.
When you look at the history of currencies, it's astonishing how consistently fiat currencies, those not backed by physical commodities like gold, end up collapsing. Whether we're talking about the German paper mark in the 1920s or the Zimbabwean dollar in more recent times, there's one common theme: fiat money eventually fails. This is not just some niche opinion. It's a historical pattern that we've seen time and time again. The modern fiat currency system, largely established in the post-war period, especially after the collapse of the Bretton Woods Agreement in 1971, has lasted about 50 years now. That's already longer than many other fiat experiments. The collapse of Bretton Woods was essentially the last tie to gold for many countries. And what has happened since? The global economy has increasingly become a house of cards built on debt, speculation, and government promises. But how long can this house of cards stay up? Alasdair Macleod brings up an important point here. If you look at the survivability of fiat currencies throughout history, the system we're using today is already well past its sell-by date. It's kind of like keeping a carton of milk in your fridge that's been expired for a couple of weeks. You can keep pushing it to the back and hope it'll be fine tomorrow, but at some point, you're going to have to deal with the consequences. That's the situation we're in today with the dollar and other fiat currencies. The key difference between gold and fiat money is that gold has intrinsic value. It doesn't need a government decree to be valuable, it just is. Fiat currency, on the other hand, relies entirely on trust in the government that issues it. And let's be honest, how much trust do most people have in their governments today? Whether it's reckless spending, political polarization, or constant bailouts of failing institutions, governments around the world are testing the limits of public confidence. One of the critical arguments Alasdair makes is that we will eventually see a return to a credit system backed by gold. And why is that? Simply put, because gold provides a level of security and stability that fiat currencies cannot. With gold backing a currency, it becomes a gold substitute, a tangible asset underpinning the value of the money supply. It ensures that governments cannot just print more money on a whim, which inevitably leads to devaluation. Now, a crucial question comes to mind. Why haven't we switched back yet? The answer lies in the fact that the current system benefits those in power. Politicians love the ability to print money because it lets them spend without raising taxes. It's like giving a child a credit card without setting any spending limits. They'll keep swiping until someone forces them to stop. The problem, of course, is that someone eventually pays the bill, and that's where the taxpayers and everyday citizens come in. The hidden tax, as Alasdair notes, is inflation, which erodes the purchasing power of your savings without you even realizing it. What makes the situation today even more precarious is the response from other global powers, notably Russia and China. Unlike Western countries, these nations seem to understand the pitfalls of fiat currency and are taking steps to hedge themselves against a potential collapse. As Alasdair points out, Russia, with its relatively low government debt, about 21 to 22% of GDP even after heavy military expenditures, is well positioned to make a move toward a gold-backed currency if it so chooses. And it could do it easily, tomorrow if it wanted to. This isn't just speculation. We've seen how countries like Russia and China are actively accumulating gold and reducing their exposure to US dollars. They see the writing on the wall. They understand that when, not if, the dollar collapses, holding gold will provide a buffer against the chaos that follows. The strategy for these countries is clear. They want to insulate themselves from the fallout of a Western financial collapse. And gold is their ticket to doing just that. Unlike the dollar, euro, or yen, which are all subject to the whims of central bankers and governments, gold is nobody's liability. It doesn't depend on anyone's promise to pay. It's money that has survived for thousands of years, and it will continue to hold value long after fiat currencies have come and gone.
Individual events occur, and you're right, it's difficult really to assess the importance of those events until they play out. But I think by far the most important thing to understand in terms of market valuation is the disconnect between bond yields and equity indices. Usually what happens towards the end of a bull market in equities is that you find that economic conditions are such that interest rates have already started rising, bond yields have already started rising. A tension develops between the valuation of the equity markets and the bond markets, and it sort of pulls apart like that, and then suddenly it snaps. This is, I think, what we're seeing. If you chart the 10-year US Treasury yield, invert it and put it alongside the S&P, you will see that an inverted yield and an S&P generally correlate pretty tightly. There have been exceptions. The first big exception was the dot-com bubble and in the years following that. The second big one was COVID, where with the suppression of interest rates to the zero bound, the yield on the 10-year US Treasury just collapsed down to less than 1%. The third one, which is the one we're in now, is the biggest disconnect in terms of valuation that we have seen in history. Now, it is closed a little bit with the yield on the 10-year US Treasury coming off a little bit, and at the same time, the S&P 500 itself coming off a little bit. So that gap has closed a little bit. We are now in the situation where having the S&P having continued to sort of climb while bond yields were climbing, that disparity is so great that the snap is now in place. It's just a question of what triggers it. And what has happened is that the The institutions in Japan, in particular, over many years have sought higher yields abroad by investing in foreign bonds, particularly US Treasuries, and also some of the European bond markets as well. They have also invested quite a lot in US equities. So we have this situation where with the outflows of capital accelerated by the carry trade, as individual institutions in the US and elsewhere would rush out and borrow yen in order to sell the yen to buy dollars and then invest the dollars in T-bills for a yield pickup really of about 5%, leveraged up so that your return on your underlying capital is probably 50% if you leverage it up 10 times. You can see how this thing was taken to excess. And this was why the yen rate against the dollar fell from around about 100 to about 161.5, which was the lowest level for the yen. The numbers are upside down, incidentally. You need to invert the chart. And then everybody got wind, if you like, that the Bank of Japan was going to change its policy and actually raise interest rates from 0.1% to 0.25%. Wow, what a shocker. But what it did was it triggered an avalanche of reversal of the carry trade, as suddenly there were huge losses on the capital side of the carry trade, particularly where people actually hadn't covered for the exchange risk. And at the same time, you were finding that the Japanese pension funds and insurance companies were making, they were facing quite big losses where they were going out into term debt. And so really what they were doing is they were trying to liquidate their foreign positions as the currency was recovering, because the currency was wiping out any profits that they had or making their bond losses even worse. So they were basically selling dollars, buying yen.
In Alasdair Macleod's analysis, there are striking parallels between the economic turmoil of today and the crisis of 1929. Let's unpack this idea because it sheds light on why holding gold and silver might be more important now than ever before. The market behavior we're witnessing, the sudden shifts in investor sentiment, the frantic changes in monetary policy, and the disconnect between asset values points toward a deeper crisis brewing beneath the surface. When we think about 1929, it wasn't just a market crash, it was the domino that triggered a chain reaction of events leading to the Great Depression. The FED, in the aftermath of the initial panic in 1929, did what central banks today are still doing. They intervened. They lowered interest rates, injected liquidity into the market, and tried to stabilize the banking sector. It sounds very familiar, doesn't it? Fast forward to today, and we have a similar pattern. Central banks are stepping in to support the markets and provide liquidity. But here's the catch. It might not work this time, just as it eventually didn't work back in the 1930s. Macleod breaks down the crisis into stages, and understanding these stages can give us a roadmap for what might lie ahead. First, there's the initial panic. This is the moment when everyone realizes that asset valuations are unsustainable. Investors, seeing the value of their holdings plummet, start dumping assets. Banks, worried about the collateral backing their loans, also begin to panic. It's a moment of widespread fear and uncertainty. The Fed and other central banks, in response, step in to stabilize things. They cut interest rates, offer bailout packages, and assure the public that everything is under control. This is where we are right now. We've had emergency rate cuts, quantitative easing, and a range of interventions designed to calm the markets. It's worked to an extent, just like it did in the early 1930s. However, the real danger comes after this initial period of calm. Historically, after a brief recovery in the aftermath of the 1929 crash, the markets began a long, drawn-out decline, eventually losing nearly 90% of their value by 1932. Why? Because the underlying issues hadn't been addressed. The system was still over-leveraged, consumer confidence never fully recovered, and the structural imbalances in the economy remained. Today, we face a similar situation. The debt that has been built up over the last several decades is astronomical. Central banks have tried to manage this by suppressing interest rates, essentially making borrowing cheap. But this has only encouraged more debt accumulation. When interest rates eventually rise, and they will, whether by market forces or central bank action, it will trigger another wave of defaults and panic. This is why owning gold and silver is crucial. It's a way to step outside of this entire debt-driven system and hold an asset that doesn't carry counterparty risk. Another point that Alasdair brings up is the disconnect between bond yields and equity valuations. Typically, when bond yields rise, equity markets fall. This is because higher bond yields make equities less attractive by comparison. Why take on the risk of owning stocks when you can get a decent return from a safe government bond? But today, we see something unusual. Bond yields have been rising, yet equities have also remained elevated. This disconnect cannot last forever. So why is gold so valuable in this kind of scenario? Alasdair Macleod makes it clear that gold is not about getting rich. It's about preservation of wealth. It's about holding an asset that isn't someone else's liability. In a world where everything is interconnected, where the failure of one institution can lead to a cascade of failures across the system, gold stands alone as a true safe haven. Silver, too, plays a crucial role here. While it's often more volatile than gold, it has unique advantages. For one, silver is both a monetary metal and an industrial one. It's used in electronics, solar panels, medical devices, you name it. This dual demand makes silver incredibly attractive, especially as the world moves toward green technologies. Think about it. If silver is both an investment and a necessary industrial component, its value is likely to rise, regardless of what happens to the financial system. The gold-to-silver ratio is another interesting metric that Alasdair touches upon. When the economy is struggling, gold typically moves first as investors seek safety. Silver often lags behind, but when it moves quickly, often outpacing gold on a percentage basis. It's like being in a race where gold sets the pace, but silver, once it starts, sprints past. This is why silver is sometimes called gold on steroids. It has the potential for outsized gains once the broader market wakes up to its value. Finally, Alasdair makes a powerful point about the level of misinformation that's being fed to the public. Whether it's the unemployment numbers that don't reflect reality, the CPI figures that underreport inflation, or the supposed strength of the economy, there's a deliberate attempt to paint a rosy picture. It's not the Bureau of Labor Statistics, it's the Bureau of Lies and Statistics, as Alasdair quips. The reality is that things are far worse than the official narrative suggests. And this is why the general public needs to wake up. If you're watching this and thinking that everything will just go back to normal once the central banks step in, think again. The debt levels are too high, the leverage is too extreme, and the trust in institutions is eroding. The only way to protect yourself is by holding assets that lie outside of this system. Gold and silver. These metals aren't just investments. They're lifeboats in a sea of uncertainty. They're a way to step outside of the system and hold something tangible, something real. And in the coming months, as the true state of the economy becomes clear, the value of these metals will become undeniable. We're heading into uncharted waters. The next 8 weeks could be some of the most consequential in recent history. Between the upcoming BRICS meeting, potential shifts in global monetary policy, and the looming elections, there's no shortage of uncertainty. And in times like these, it pays to be prepared. Gold and silver have stood the test of time. They've preserved wealth through empires rising and falling, through financial crises, wars, and everything in between. They're not just metals, they're history, distilled into a form that you can hold in your hand. And in the months and years ahead, having even a small amount of your wealth in these metals could make all the difference. The writing is on the wall. The window to prepare is closing. Don't wait until it's too late to act.